Other taxes at death, which is our Module 6 for Week 3. Income in respect to the decedent, we mentioned this in earlier modules. The estate tax, as we also mentioned earlier, is an accrual and thus picks up items that the cash system that you use for your income tax doesn't. The income in respect to the decedent is income the decedent was entitled to before death but received after death. Again, that's part of the accrual basis. Those of you with an accounting background are familiar with it. If you don't have an accounting background, the easiest way of thinking of it is a cash basis is you keep track of the cash coming in, cash coming out. Where if it's an accrual basis, it's the responsibilities going out and the liabilities of what's coming in. It cannot be included in the pre-death personal income tax return as that return is based on actuals. So the income in respect to the decedent return is going to be shown on the state tax return, which is a fiduciary return if it's under a probate. If it's not under probate, it's got a will substitute. It's probably going to be paid directly by the beneficiaries. Hopefully they pay it on time. Otherwise, later the IRS comes after and charges penalties and interest. Alternatives for income in respect to the decedent. It's included in gross estate, pay taxes on it, and the beneficiary doesn't pay taxes on it, nor receive stepped-up basis. So we pay taxes on it on the gross receipt, and the problem is that it's a higher tax rate, so it doesn't usually make sense. So the second option is usually the best one. Remove the income respected decedent from the estate fee adjustments to gross estate, and the fiduciary beneficiary pays the taxes at a much lower rate. Again, you're usually talking 35% minimum rate with the tax under a estate tax, and typically the rate is lower under the individual tax payment. But again, you have to punch the numbers. You have to go through and do the calculations each way to see which is better. Retirement plans are unique in the gross estate. The benefits outstanding of a retirement and or pension plan go into the estate. That part of the plan that is not basis, in other words, the decedent didn't pay taxes on it during the lifetime, is subject to income tax on the part of the beneficiaries. That is an important thing to remember, because if it is a typical retirement plan, most of the assets are not taxed during lifetime, and therefore the beneficiaries are going to pay taxes. Now, there are adjustments made for any tax that was paid in the estate tax related to retirement plan, but that would be the big difference. The other point I might mention that the Roth IRA, of course, does not have this problem if it's the first generation. So if I have a Roth IRA and I die and leave it to my son, he doesn't pay tax on that at all, even though the Roth is included in my estate, but he doesn't have to pay any tax on the income. Where if he dies and that same Roth that he inherited from me comes in, then the same situation occurs that we have here, which is the income is going to be taxed. Choice of income tax venue. After death, a federal income tax is required to cover the period up to the day of death. It can be filed if married jointly or married filing separately. And we're going to find that the surviving spouse also has tax advantages. Again, when you do this, you have to calculate out what's the best for the client. That might be a joint return. In some cases, it's married filing separately, depending again on the type of expenses. Fiduciary returns. A state tax return for income in respect to the decedent is filed on the fiduciary income tax return. And this is also the same type of return you'd use for trust, which we'll be covering later in the course. Flexibility in the fiscal year is used after death. And what I mean by that is that when we have a chance to use a short year. In other words, we have a right to use a period less than 12 months for our first year, which means effectively we can use 2 tax years to cover the income tax associated with the first year. The advantage to that, quite candidly, is that you are only going to pay at a lower progressive tax rate, because if I take 100,000 and split it over 2 years, it's 50,000 each. It's a lower tax rate than if I have 1 year at 100,000. Again, that isn't always going to be true, and you have to crunch the numbers, but typically there is an advantage to use the short tax year. What is taxed at a lower net cost? Estate tax or gift tax? Gift tax is tax exclusive, that's only taxed at the value of the gift. Estate tax is tax inclusive, that's taxed on the bequest and the related tax. So we're going to find that the estate tax is a much higher tax than the gift tax, which means after we get through week 4, we have to start strategizing what is best from the client standpoint and the beneficiaries as far as making a gift or estate bequest, because the tax is going to be substantially different. And my general rule is that I'm going to use gift tax if I don't expect to have a estate tax, because I can use my lifetime exemption of $5 million or so today. Where if I'm going to pay estate tax, I'm probably going to save that lifetime exemption for gift tax, which we'll be talking about in the next week, so that I can reduce the estate tax, because it's a much higher tax. But there again, you have to crunch the numbers, you have to look at the goals of the clients and where the clients stand, as opposed to what the tax rates are. Most changes in estate gift tax, most changes in gift estate tax are for where the threshold for taxes are required, and also what the minimum tax rate. These vary many times by year. Unfortunately, many times they are determined at the end of the year, retroactive for the year. And also remember that the gift tax is only tentative until such time as the year of death. So there's a lot of variables in this thing that have to be estimated at as you're doing your tax planning. And I think that we all realize that crunching the numbers is the only way to do it. And you can be very, very conservative, very liberal. I wish you could say there was a nice medium. I tend to be conservative. In other words, I expect the tax rates to be high and the thresholds to be low, so that the client is probably in the best case. That also forces them probably to think more about buying insurance, which we'll talk about later in the course. And I personally think you need insurance for any estate. And with that, we're going to close it off for this week. And best of luck on your quiz.